More Business Briefing right now on FM News 101.
And back with the final half hour of Business Briefing here to wrap up our Sunday afternoon as it turns to evening across the region. We call on Michael Lortz, our accounting expert from Geffen Mesher. And Michael, welcome to the show. Some big changes in Oregon recently that not only impact Oregon businesses, but our Washington businesses that are doing business in Oregon, right?
Yeah, the so-called grand bargain, which I'm sure people have heard a little bit about in the news, particularly in Oregon. You know, that grand bargain certainly contained a lot of provisions that weren't tax-related, but there was actually quite a bit in there that impacted taxes both for businesses and individuals.
Let's talk about this, and it's kind of goofy what they did. I mean, for lack of a better word, there's going to be a lot of questions about this, but let's start with C corporations.
Sure. So C corporations, I guess you could say they get the short end of the stick. They have a tax increase to deal with, and this tax increase is retroactive, essentially. It's effective the beginning of 2013. So here's the deal. Corporate tax rates are typically at 6.6% in Oregon. However, there's an additional 1% increase to 7.6% once you hit a certain revenue threshold, a certain income threshold. Well, what happened was they said that 7.6% rate would take effect once taxable income hits $1 million. It was scheduled to take effect at $10 million. So all of a sudden, a lot more corporations will be subject to this extra percentage point tax.
That is a big difference. And why do you think they chose to cut that back from 10 to 1? I mean, that is a huge jump there.
Yeah, it absolutely is. You know, this all kind of hails back to Measure 67 a number of years ago. And at that time, the 7.6% applied once taxable income was over $250,000. Again, it was scheduled to go back up to $10 million. The $1 million is sort of the middle ground, I suppose, and I think that's how they justified it.
Okay, with individuals, and there's also some changes here. Let's talk about that.
Sure. So individuals, some of these changes will help folks, and some of these will be costly. So there's a sort of a new income threshold, it appears, in the state of Oregon. If you make over $200,000 as a married couple or $100,000 as a single person, that's where they're starting to eliminate deductions. So, for example, the personal exemption credit, which is something that everybody who's an individual who files an Oregon tax return probably has seen before on their tax returns, that now goes away if your income is above those thresholds.
Interesting. So now you get phased out when in the past that was never the case.
Yeah, there have been phase-outs, but they've always been at higher income thresholds, and so they've really dropped it to what appears to be a new standard.
Now, it's interesting, this next one, with everything that's happening with Affordable Care Act, Obamacare, and all the controversy there, they delve into some issues with medical deductions. Tell us about it.
Yeah, that's right. So for a number of years, Oregon has had a provision that allows seniors to take a special deduction for medical expenses, out-of-pocket costs. The age that they've applied is age 62. Well, starting in 2013 again, we've got a number of changes. Number one, they've capped that deduction at $1,800 per taxpayer. So a married couple would be double that. A single person would be just $1,800. In addition, they're starting to phase this deduction out. The phase-outs start at $100,000 of income for a couple, $50,000 for a single person, and by the time you get to that magical $200,000 for a couple, $100,000 for single, you would get zero at that point.
Now, is that adjusted gross income then?
That is taxable income.
Okay.
And in addition, they're also ratcheting up the age. So, as I mentioned, it's been age 62 where you've started to qualify for this deduction. They're ratcheting that up slowly over time to age 66 by the year 2020.
Well, you're making more money, you're living longer. They're not going to let you enjoy those tax benefits. Michael Lortz, Geffen Mesher, joining us here on Business Briefing. One other thing, too, I noticed that they're going to bump things up a little bit from 6 to 8% in 2014. What's that all about?
Yeah, so this relates to the earned income tax credit. So Oregon has what I would call sort of a piggyback credit. If somebody qualifies for the earned income tax credit on their federal return, Typically, that's somebody who has low income. Often, but not always, there's children living at the house, etc. Oregon has offered a credit which is 6% of the federal credit. That now becomes 8% of that credit.
Okay, there is good news. You told us some good news about the B&O tax in Washington on your last visit. It's always good to have a little bit of good news, so there is some give and take here. Tell us about it.
Yeah, so this, again, was very interesting, this package of laws, because it does include a tax cut. And this tax cut relates to businesses. It relates to pass-through entities. Those would be S corporations and partnerships. And what it does, starting in 2015, mind you, is it provides for lower tax rates related to a portion of that business income. So, for example, the top Oregon tax rate right now is 9.9%. That rate can be as low as 7% now on the first $250,000 of income from a pass-through entity.
And from there, they slowly ratchet things up, don't they?
Yeah, that's right. So it goes from 7 to 7.2, then 7.6. By the time you get to $1 million of income from one of these businesses, the rate goes to 8%. It finally goes up to 9.9% once you're over $5 million. So it is some significant savings potentially, although there are a few other rules you have to meet in order to qualify for this.
It's interesting. So S-corps, you've got partnerships, LLCs in this, but not sole proprietors, and that's interesting. I would imagine you're going to have some sole prop people who are going to want to change the structure of their business.
Yeah, absolutely. That's one of the first things that jumped out to us as we were reviewing this legislation. And I don't know why it is, but for some reason, sole proprietors do not get this tax cut. So I would imagine that a lot of sole proprietors will be taking a hard look at forming S corporations, perhaps adding partners, even if it's a family member, to form a partnership. Who knows what sort of rules will exist? The Oregon Department of Revenue is going to have to provide some guidance as to how they're going to administer this new law. But I suspect there will be some entity restructuring as a result.
Michael Lortz joining us from Geffen Mesher. And one thing to point out here, we've seen the state of Washington be very aggressive in coming after Oregon businesses in regards to the B&O tax. And I noticed here that this will also be for a lot of the people who live in Washington, may have a side business that they operate solely in Washington, but yet they may work in Oregon. We're only talking about Oregon income that's earned in Oregon, right?
Yeah, so again, these are pass-through entities, which means if somebody has a business in Oregon, perhaps they're a Washington resident, they're having to file Oregon income tax returns to report that Oregon income. These tax cuts can apply to that Oregon income even though the business owner is a resident of another state. Now, I should point out that there are a few other qualifications that have to be met to get these tax cuts. So, for example, you can't simply be a passive investor to benefit from this. This requires the taxpayer to be materially participating. There's a number of ways to meet that test. The most common, though, would be to work at least 500 hours in that business. In addition, the company has to have at least one non-owner employee. And they hail back to the Obamacare standard. They've got to have somebody who's working at least 30 hours per week, and in total there's got to be at least 1,200 hours worked. So interesting how these different laws start to piggyback on each other with respect to the criteria.
And one final piece here, too, that we want to talk about. Tell us about this.
Sure. So one of the most interesting things about this law is that these tax cuts might be temporary, or they might not be. And I think that's because really the legislature has had a very difficult time figuring out just how much of an impact on revenue this tax cut will result in. So there are a couple of provisions in the law that essentially cause the Oregon Department of Revenue to evaluate how much revenue has been reduced as a result of this law change. And if it's more or significantly more than anticipated, these tax rates will go back up, perhaps even all the way back to the 9.9%. And that's built into the law so that the legislature doesn't have to pass a separate law increasing the rates.
Michael Lortz, Geffen Mesher, if you'd like to contact him, email mlortz@gm